Louisville's apartment market was one of the nice surprise stories of 2011 and 2012. Is that momentum carrying over into 2013? We'll take a look. Welcome to Apartment Market Dynamics from NPF Research. I'm Jay Parsons with your Louisville update. In 2011 and 2012, Louisville was an under-the-radar, top-performing apartment market. It did surprisingly well, showing good growth in both occupancy and in rent. But, of course, you want to see sustainable momentum, so let's take a look at the most recent stats, starting with occupancy. Occupancy dropped off in the winter months, but it did climb back with a good performance in Q2, up 50 basis points to 95.2%. Very solid rate. Occupancy here is now averaged just above 95% since the start of 2011. Nice to see. But with occupancy basically recovered, there really isn't much potential to gain much more on the revenue side from occupancy, so that puts more pressure on operators to achieve rent growth. And there certainly were getting good rent growth in 2011 and 2012, as you could see. Annual rent growth came in around 4 to 5% for much of that 2-year period, peaking at 5.7% in Q3 of 2012. Not many markets did that well over that 2-year stretch. But rent growth levels have eased in each of the past 3 quarters, up 2.7% as of Q2 2013, and that put Louisville back below the U.S. average, which came in at 3.1%. So what do these trends tell us about the Louisville apartment market? Well, these trends are very similar to what we're seeing across most of the Midwest region. Now, Louisville, of course, is not technically in the Midwest. It just misses that official geographic designation because of the fact that it's on the other side of the Ohio River. But the Louisville market behaves very similarly to what we see in the Midwest, and that certainly carries over to the apartment market. Much of the Midwest did quite well in the past couple years due to a mini rebound in the manufacturing sector, and that was the case in Louisville as well. The auto industry was actually a big part of the story here, as it was in much of the Midwest, but the pace of manufacturing growth has started to slow down, and that has led to some normalizing apartment fundamentals across the Midwest and across the Ohio River into Louisville. Now, that's not to say these markets are in bad shape. In fact, apartment fundamentals in most of these markets in the Midwest are actually looking pretty solid, but it just tells you pretty much what we thought all along, which is that that strong revenue growth that we saw in 2011 and 2012 just wasn't really sustainable. Now let's wrap it up with a submarket snapshot here, Northeast Louisville. This is one of the most desirable areas to live within the metro, but it's not immune to the recent trends. Occupancy here has fallen 40 basis points year over year, right in line with the metro norm, though it remains quite healthy at 96.6%, one of the best rates in the metro, and rent growth is still healthy too at 3.3%, but like the metro overall, the rent growth numbers are trending downward from the big hike seen previously. So what we are now seeing in Northeast Louisville and really all across the Louisville metro area is more likely what we'll see going forward. We're just seeing a return to normal, and we think that we're going to continue to see this leveling off over the next couple of years. Occupancy should stay healthy as it is, and rent should be, we're expecting to be climbing around 2.5% to 3% on an annual basis going forward. And that wraps it up for Louisville. So until next time, for Apartment Market Dynamics and NPF Research, I'm Jay Parsons. Thank you for watching.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.